Good morning. Bonjour. Welcome to this year's Michel Camdessus lecture. We're extremely happy and privileged to welcome Madame Christine Lagarde to the lecture this year. Of course, Christine Lagarde is the president of the European Central Bank, and she's also the former managing director of the International Monetary Fund. In addition, she was the one to launch this lecture series back in 2014. So this year is the 11th edition of the series. We're very much looking forward to Christine's lecture. Let me first turn to Kristalina, our managing director, to present opening remarks.
Thank you, Tobias. Before I say a word, Christine, you're back in your home. So can I get from our troops and our guests a big round of applause for Madame Lagarde? I want to join Tobias in welcoming you all to the IMF. Those of us who work here, great to see you on Friday. Not so usual. And recognize that this lecture is special. It is our signature lecture. It is a series of central bankers usually coming and talking about top of mind for this community. I am very grateful to Christine for agreeing to come. Christine, as the President of the European Central Bank, plays an incredibly important role in these turbulent times. And her wise judgment has been on display over these years. Extraordinary professional standing, personal charisma. Always she stands above us physically, figuratively, and also in terms of her incredible contributions. Remarkable prominence, respect, and admiration all over the world. She needs no introduction, least in this house, because during the years, Christine has been the managing director of the fund. She has led this institution ably during very difficult times. These were the times after the global financial crisis, the times of the Eurozone debt crisis. It was also time for the fund to implement decisions around quarters of our members, very important for the legitimacy of the fund. Christine broadened our perspective in a rapidly changing world so we can reflect on inequality, governance, gender, and climate appropriately from the mandate of this institution. During COVID, something that Christine led, the adoption of social spending floors, came to be exceptionally important. It made a material difference in the work of the fund. And Christine, I'm immensely grateful for the fortunes I have to come after you in this position and to advance what we inherited. I'm also a direct beneficiary of your relentless pursuit of the place of women. As the first woman chair of Baker McKinsey, first woman minister of finance in France, first woman managing director at the fund, now first woman president of ECB. And I can vouch from my experience that when you break the glass ceiling, much easier for the woman that follows to come through. no cuts. I am also recognizing the importance of establishing the Michel Camdessus lecture series. Why? Because we have the necessity to reflect and think about what we have learned and where we are headed with the best and the brightest. And obviously, you are among the best and the brightest. Before I turn to you, Christine, what I want to do is to briefly reflect on developments since last year when we had the Camdessus lecture. Some of our guests and many of our staff were here at that time. This has been a year of determined action of central banks, of synchronized tightening of monetary policy to address the surge of global inflation. Not popular, but necessary. Despite of all these actions, we have seen through the year inflation remaining stubbornly high. It generated in some places concerns about the effectiveness of monetary policy. Can monetary policy still do the job? We fast forward to today, and we are clearly in a better place. Inflation has declined significantly to or near target in many economies as a result of the resolute action of central banks, as well as, we have to recognize that, as well as of fading supply shocks. The forces of monetary policy transmission have reasserted themselves in the end. Now, we are in a better place, but we cannot be complacent. First, in many countries, services inflation is persistent, and inflation could yet tip upward. Second, in a more shock-prone environment, we simply don't know what surprise may hide around the corner. Since COVID and Russia's invasion of Ukraine, it has become clear that central banks need to scan the horizon beyond monetary and financial sector developments. And above all, we know central banks face a difficult balancing act. They must ensure that inflation sustainably returns to targets and remains there while avoiding the risk of excessively tight policies. This is particularly important in a world faced with a low growth, high debt conundrum. Yet, we can be reasonably confident. We have entered the famous last mile in the fight against inflation, allowing most central banks to move into an easing cycle. ECB in June, the Fed this week. We saw Canada a bit earlier. And that marks a very important development. At the Fund over the last year, since we met here for the previous Camdessus lecture, we have been on the side of the soft landers. Our analysis has demonstrated that it is possible and likely to have a win against inflation without a sharp global downturn. And in fact, while clearly weaker than we would have wanted, economic activity has been remarkably resilient. We are projecting global growth to be more than 3% this year and next year. So what next? The fight against inflation has come against the backdrop of 4.5 years of extraordinary challenges for central banks. And while inflation is retreating, rates are going down, recession appears to be unlikely, challenges are abound. We are living in a more shock-prone world, a world in which geopolitical considerations turn into geoeconomic fragmentation, and a world of tremendous structural shifts due to the green and digital transformation. And in this new world, central banks must be vigilant to the potential for shocks to unleash powerful inflationary forces and create difficult trade-offs. They have to struggle with the challenges presented by the non-banking financial institutions. They have to reflect on the opportunities and risks from artificial intelligence. As you have done in ECB, Christine, they cannot ignore climate-related financial stability risks, nor the opportunities for growth and jobs from the green transition. I cannot think of a better person to come and talk to us on these issues, on the structural shifts that are underway, and what does it mean for the work of central bankers. I am delighted that you have chosen for your lecture a theme that I believe would resonate with this audience and those who are with us online. Setbacks and strides forward, structural shifts and monetary policy in this decade, in the 20s. Very much look forward to listening to you, Christine, and again, a very warm welcome from all of us.
Well, good morning to all of you, and thank you ever so much, Kristalina, for the extremely and exceedingly kind words that you have mentioned to me. You know, many of you probably appreciate the level of emotion that I feel at this point in time. So I'm not going to digress too much about the past. But being here in this room with you all, under your leadership, Kristalina, seeing so many of the faces, the smiles, the bright eyes, the brain power that I have experienced over so many years here, and seeing colleagues who have been my companions during these years, is very moving to me. So I will spare you the tears, but I'm not very far from that. So... Now, for some of you, it probably doesn't mean anything because you've joined since I left. But I had a love story in this institution. My husband would probably not be too pleased. So, Michel Camdessus. The first time we had this lecture, Michel Camdessus, some of you will remember, was with us. He was here. So, I gave him a call before I came over. And he asked me to pass on all his warm regards, the high esteem that he has for everyone, and the fantastic memories that he has himself from his tenure as managing director of the institution. So here I go. I'm just the messenger of Michel, but he wishes all of you the best in the work that you do and in the mission that you serve. Yeah, he was a great guy. Third, I want to thank you for not having invited me in the last 5 years. Because these are the years that I spent away from you, and I would not be able to deliver the kind of speech that I will deliver for you if it hadn't been for those 5 years and the extraordinary learning, analysis, input that I got from the fantastic staff of the ECB. And I'm forever grateful to you all for having trained me into many macroeconomic matters, many surveillance matters, many program matters, and all the rest of it. But I'm very grateful to them for having taught me at least the basics of monetary policy. I don't pretend to be the top-notch modelist that can deal with all non-linearities. But at least I understand the jargon a little better, thanks to them. I apologize also for having asked that what I say be removed from the screen, because I'm notorious for moving away from the script that I have. Although as a central bank, not so much. And I've been suffering from that, but I'll try to follow the rules here. So, you are all familiar with what central banks are, but it's only really when you get under the skin of a central bank that you realize how those public institutions have powerful tools. But the way in which these tools affect our economy is constantly changing. And this uncertainty comes in part from the famous long and variable lags of monetary policy transmission. When I was first, pointed to that lag, I said, well, yeah, okay, lag, I understand, fine. I've read a bit about it, but how long? Whoa, that depends. But when push comes to shove, eventually advisors will say, and I'm speaking under their control here, between 18 and 24 months. So think about the dilemma that a central bank president, governor has and his team. You decide things that have an impact that will be measured 18 months, 24 months down the line. And yet the measures that you take are instantly communicated, and there is instant expectation in this world of instant gratification. There are also fundamental issues that affect the transmission of monetary policy. And here I'm going to quote somebody who actually came to speak, not on those issues, but who came to speak, whether at the Camdessus lecture cycle or somewhere else, and that's Alan Greenspan. So Alan Greenspan famously wrote 20 years ago, and I quote, "The economic world in which we function is best described by a structure whose parameters are continuously changing. The channels of monetary policy, consequently, are changing in tandem." In other words, the effectiveness of monetary policy is intrinsically tied to the evolving structure of the economy. And guess what? In recent years, we have not been spared those massive changes. And as a result, uncertainty about policy transmission has been particularly acute. And I'm going to talk about that. Close your eyes, remember 4 years ago. We had the worst pandemic since the 20s. We had the worst conflict in Europe since the 40s. And we had the worst energy shock since the 70s. And those three shocks alone have changed the structure of the economy and posed a challenge for assessing the impact of monetary policy. And this challenge was exacerbated by what? Well, by where we were coming from, because we were coming from decades of very low inflation, very low interest rate, extremely cheap energy, and a period of rather anemic growth. That was certainly the case in Europe. So what did we do? To manage that uncertainty, we introduced a three-pronged policy framework, focusing not only on forecast inflation, but also on underlying inflation dynamics and on the strength of monetary policy. So we have that three-pillar prism within which we try to define what our stance should be. And it was instrumental in helping us calibrate the rate path over the last phase of the hiking cycle, fastest at any time and point in the history of the ECB, and then during the holding period at the peak, and more recently, as we have begun to reduce the policy restriction that we had in place. And I would contend, and you mentioned that, Kristalina, that our determined policy actions have successfully kept inflation expectations anchored, and inflation is projected to return to 2% in the second half of 25. And if you consider the size of the inflation shock that we suffered, which at its peak was 10.6% in October 22, and which has now returned to latest reading is 2.2%. This unwinding is remarkable. But is the uncertainty gone? No, there is still plenty of that around. The economy is going through transformation, the impact of which we need to better understand and we need to continuously analyze. And while some of those changes, like climate change, like the aging of our societies, are unique to our times, others look like those that took place a century ago. Two specific parallels between the two 20s, the 1920s, the 2020s, stand out. And then, as now, we are seeing a setback in global trade integration and a stride forward in technological progress. But these similar changes that took place a century apart affect monetary policy in a very different way, because we're positioned differently. In the interwar period, structural shifts affected prevailing monetary policy strategy. The main lesson for central bankers then was that the dominant paradigm was not robust in times of profound structural changes. That realization led a few decades later to the emergence of modern monetary policy strategies with a core focus on price stability and flexible policy strategies to deliver it. And thanks to these developments, we find ourselves better positioned today to address these structural changes than our predecessors were. The challenge that we face today is not about our goals, which have proven successful, not about our tools, which are sufficiently flexible, but it's rather about the monetary transmission that will be affected by structural shifts and how our analytical frameworks should adjust to those shifts. So what I would like to do, I hope you bear with me for the moment, but what I would like to do is start exploring the parallels that we see between those 20s in the 1920s and the current 20s that we are going through, while highlighting how these changes have different implications for monetary policy in each era. And I will then, by way of conclusion, try to offer some preliminary considerations for the evolution of policy framework. Okay, so I'm going to take you back into the past. But before I do that, I just want to clarify that my main message today is that we must be ready for change and prepared to use the flexibility of our frameworks as necessary. And to ensure future stability, our approach must continue to embody stability without rigidity. Stability without rigidity, allowing us to swiftly adjust as the economy transforms, as suggested 20 years ago by Chair Greenspan. So let's go back into the 20s. The world economy then went through a series of massive transformation. These shifts pulled in different directions, representing both setbacks and strides forward from the previous environment. They changed fundamentally the structure of our economies. And I will mention two of those shifts which had major implications for monetary policy. The first one was global fragmentation. Sounds familiar. That global fragmentation that put an end to the open liberal economic order of the late 19th century and its assumed permanence. The decades prior to the First World War had been ones of rapid global integration. World trade as a share of GDP rose from 10% in the 1870s to 17% in 1900 to 21% in 1913. Creating expectations and lifestyle. And I'm going to quote John Maynard Keynes. He famously wrote, "The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth, in such quantity as he might see fit, and reasonably expect their early delivery upon his doorstep. He regarded this state of affairs as normal, certain, and permanent." Quite amazing. At the same time, the dominant paradigm among major central banks was the gold standard, which prioritized maintaining external equilibrium and relying on intrinsic mechanisms for domestic credit to adjust to external imbalances. And then the war came. And that war brought to an end what we call then the Pax Britannica, while the US was at the time reluctant to assume the role of global hegemon sustaining open trade. Economic nationalism rose, and a rapid unraveling of globalization followed. World trade as a percentage of GDP fell. Remember, it was 21 in 1913. It fell to 14% in 1929 and 9% in 1938. Tariffs in most European countries more than tripled and also rose in the United States. Major central banks initially attempted to revive the gold standard in the mid-20s to recreate the conditions for open trade, but they faced a worsening trade-off. As Ragnar Nurks showed in his study, in a more unstable world, central banks increasingly had to use gold reserves as a buffer against external shocks rather than allowing them to transmit to domestic credit growth. And while intended as a second-best policy to maintain a degree of domestic stability, this approach ultimately exacerbated deflation pressures. Deflation, in turn, fueled economic malaise and contributed to the cycle of economic nationalism. That was fragmentation. The second major shift in that period was rapid technological progress. And technology unambiguously took a step forward. It unleashed a series of changes in the economy and financial markets that created new challenges also for central banks. Innovation accelerated rapidly in that period, largely fueled by spillovers from wartime advancement. Machinery was introduced. Progress was most visible with the internal combustion engine, the assembly line pioneered by Henry Ford, and the electric network and motor. The technological boom drove rapid productivity gains. In Britain, for instance, in the famous factory of Austin Motor Company, in 1922, to actually produce a car required 55 employees weeks. Fast forward, 5 years later, 1927, it was no longer 55 employees week, 10 employees week in a matter of 5 years. And for Europe as a whole, the average rate of productivity growth rose to over 2% per year between 1913 and 1929, compared to about 1.5% in the decades before. Irrational exuberance, thank you, Alan, about technology also fueled a significant rise in stock market valuations. Research indicates that 1% increase in a firm's stock of cited patents corresponded to 0.26% increase in market value during the 20s. But central banks did not have the means and the tools to deal with these booms and busts. Several of them tried unsuccessfully to pop stock bubbles, and then they took a series of wrong turns when the crash came. The resulting banking crisis and a return to the deflationary stance are now widely considered to have played a significant role in exacerbating the Great Depression. A key lesson ultimately became clear for governments. Central banks needed a new concept of stability, and this concept had to be reflected in monetary policy strategies. As the historian Michael Bordeaux observed, in the 20s, central banks tried to focus on both external and internal stability, and I quote, "But as long as the gold standard prevailed, external goals dominated." So the main realization of the interwar period was that central banks in advanced economies needed to be assigned domestic stability targets first and foremost. But then it took another 30 to 40 years to realize that they would do better stabilizing inflation rather than fine-tuning output and employment. So, 1 century later, we are now in the 2020s. And we also face some setbacks as the global economy fractures, while seeing strides forwards with transformative digital technology expanding. But the consequences for monetary policy are different. The last few years have represented an extreme stress test of inflation targeting around the globe. We have not only faced back-to-back shocks, but also a very different variety and strength of shocks in many places. For example, Europe suffered much more than the US from high energy prices, while the US had to contend with the legacies of a stronger stimulus to demand. Yet, despite those differences, inflation is converging towards target almost everywhere. And remarkably, disinflation has come, at least so far, at relatively low cost to employment. I gave a recent speech in which I actually mentioned that it is rare to avoid a major deterioration in employment when central banks raise rates in response to high energy prices. So this might be a case in point where the story is different. Consider for a second that since the end of COVID, or 2022, since the end of 2022, Europe has created 2.8 million new jobs, unheard of in that short period of time. I see 2 reasons for this greater stability. First, decades of inflation targeting have had a deep impact on how people build expectations about future inflation. And indeed, when the inflation goal is stated clearly, and if monetary policy is credible, inflation expectations will tend to remain anchored, which makes the adjustment process to an inflationary shock less painful. Second, over time, central banks have understood that stability does not necessarily mean rigidity. And we are indeed in a better situation to confront structural changes because policy strategies combine 3 elements: clearly defined inflation targets, flexible policy toolkits to deliver on those targets, and analytical frameworks which can assess and respond to changes in the economy. We have used all these 3 elements in recent years to ensure that monetary policy maintains price stability without excessive cost to the economy. But for this reason, the current changes that we are seeing, those structural shifts, are not going to revolutionize monetary policy. I stand to be corrected, but future will tell. I bet you that the goals of monetary policy are not going to be changed. But those transformations are going to have a serious impact on monetary policy transmission. Let me briefly mention the setback, and then I'll come to how I see that it could actually affect significantly monetary policy transmission. Just as we did a century ago, we are now witnessing another wave of what I will call globalization plateauing. The hallmark of this era was the geographical unbundling of production through global value chains, which led to a doubling in the value of traded intermediate goods, now accounting for over half the world trade. But that landscape is changing, and you are in the best possible position to witness that and to analyze it. We are not seeing outright deglobalization in the sense of world trade reversing, but we are seeing the structure of global value chains changing in response to a more volatile environment marked by more frequent supply shocks and fragmenting geopolitics. Our analysis finds that both the US and the euro area have recently diversified their supply of imported goods, leading to a larger number of sourcing countries and increasing costs. In the US, firms appear to be exploring the option of both nearshoring production to Canada and Mexico and reshoring at home. In Europe, the focus is on nearshoring production within the region while still exporting globally. I would like to show you how these changes have implications for monetary transmission, as they could partially reverse some long-term changes in the economy that may have weakened transmission. First, these changes could strengthen the link between domestic slack and inflation. A key puzzle that central bankers have had in the 2010s was that policy easing was transmitted strongly to activity, but in a weaker fashion to inflation. Why? Well, one explanation for this disconnect was that the expansion of global value chains reduced the impact of domestic slack on inflation by shifting the focus to global factors. However, if global value chains become shorter, as we can anticipate, or less efficient, as can be seen, domestic slack and inflation could reconnect. And this shift, I contend, could enhance the potency of monetary policy impulses. Second, policy transmission may strengthen as global value chain restructuring potentially boosts capital expenditure. Inducement for strategic sectors that are defined differently in different corners of the world, but all over defined, however. Those inducements to set up closer to home may lead to a resurgence of capital-intensive industries within advanced economies. Not the building of the plant in that low-cost economy somewhere else. No. Rebuild at home. In the United States, for instance, manufacturing construction spending has doubled since the end of 21 in response to policies like the IRA, the Bipartisan Infrastructure Law, and the CHIPS and Science Act. Such a shift could somewhat attenuate the long-term shift of activity towards services and away from manufacturing, as well as the observed slowdown in capital deepening over the recent decades. And in turn, capital deepening could increase the economy's sensitivity to interest rate changes, potentially enhancing the effectiveness of monetary transmission through the interest rate channel. By strengthening the transmission mechanism, these shifts could potentially allow central banks to exercise more control over domestic outcomes. But these benefits could also be offset if the restructuring of the global value chains led to more volatile inflation. In a stable global environment, the expansion of global value chains facilitated a virtuous cycle of trade integration and stable inflation as global value chains buffered the effect of cost-push shocks. Our research shows that a 1% increase in input prices resulted in only 0.44% increase in output prices owing to this buffering effect. But if supply chains were to shorten, it could lead to stronger pass-through of cost shocks. So a strengthening of monetary policy on one account, two accounts, potentially reducing the potency of monetary policy on the other account. Let's look now at the technological progress. Just like in the 20s, setbacks in some areas that I've just tried to describe, at least for one of them, are matched by advancement in others. We find ourselves in the midst of a digital revolution that echoes the technological boom of the 20s. Just as that era saw major development in electricity, automobiles, mass production, our era is witnessing an unprecedented growth in digital technologies. In particular, the rapid development of artificial intelligence looks set to transform a swath of industries, including the financial sector. Financial technology is already having a profound impact on finance. In 22, fintech generated 5% of global banking revenue, totaling anywhere between 150 and 200 billion US dollars. This share is expected to exceed $400 billion by 2028, growing at a clip of 15% per annum. What are banks doing? They're not sitting idle. They're buying fintechs and adopting their technology to enhance their lending operations. By changing the nature of financial intermediation and fostering competition, fintech can significantly strengthen the transmission of monetary policy decisions to the wider economy, influencing interest rate, asset prices, credit conditions, and ultimately growth and inflation. Let me give you an example. You are all familiar with credit scoring, right? Well, credit scoring and new sources of credit provided by fintech platforms can reduce significantly lending constraints. By leveraging alternative data sources involving over thousands of data points per loan applicant, fintechs using AI and machine learning have outperformed traditional credit scoring models in predicting loss rates, particularly for riskier firms. These developments are already expanding access to finance. Fintechs have been found to process mortgage applications around 20% faster than other traditional lenders. And the use of data could also alleviate the need for collateral, thereby extending credit to underserved businesses at a lower cost. So remember the Londoner who was ordering by telephone and expecting delivery at his doorstep? It's no longer the Londoner, it's the modern consumer anywhere, not necessarily from his bed, who can quickly check their creditworthiness and secure the best financial deals through their smartphone. And that is no distant fiction, it's happening. And that mirrors very much what was happening to that London guy sitting in his bed. So as a result, fintech's credit supply tends to be more responsive to changes in borrowers' business conditions or broader economic conditions, contrasting with traditional banks' emphasis on long-term relationship with customers. This responsiveness also means that their lending could be more cyclical in times of stress, amplifying credit cycles and volatility. But the net benefits for transmission hinge crucially on the effect of digitalization on market structure. What do I mean by that? Digital markets, as we have observed, tend to be affected by the winner takes all, or at least takes most, as is visible in the handful of hyperscalers that dominate digital platforms and cloud services. For example, just 3 US hyperscalers account for over 65% of the global cloud market. Google commands an outstanding market share of more than 90% among search engines. And in e-commerce, business is concentrated among a handful of top players. Okay, competition law, fight against concerted practices, all that they should do their work, and they do. But we have to look at it from our monetary policy transmission perspective. And market power has important effect on policy transmission. The IMF research finds that firms with greater market power are less sensitive to changes in interest rates. I refer to that study of yours. In the US, a 100 basis point increase in the policy rate causes a low markup firm to cut sales by about 2% after 4 quarters. In contrast, a high markup firm barely reduces its sales in response to the same policy change. So why is that? Reduced sensitivity. Well, it's likely to be due to larger profits and cash reserves of those superstar firms, which makes them less dependent on the external financing conditions affected by monetary policy. And more generally, research finds that the superior efficiency and size of superstar firms significantly reduces the labor share of income, which may also weaken policy transmission. So in short, Digitalization could make the financial sector more able to adjust financing conditions to economic conditions, but it could also make part of the corporate sector more insensitive to monetary policy. See, I've learned quite well how to do on the one hand and on the other hand. So what can we say at this stage? And I've tried to identify from those sort of 1 century apart, 2 very strong characteristics of transformation, how monetary policy transmission can be affected. It's too early in the cycle to draw final conclusions. But we can identify at least some of the key questions that central banks will face in the future. I think it's important to indicate that the core goals of monetary policy has not changed and probably needs to remain unchanged. Rather than forcing us into painful trade-offs, as happened a century ago, our monetary policy strategies have proved effective, mitigating trade-off between inflation and employment. If we enter an era where inflation is more volatile and monetary policy transmission more uncertain, maintaining the deep anchor for price formation will be essential. But as we begin to understand the effect of global fragmentation and digitalization on our monetary transmission, we will have to continuously reassess our analytical frameworks. And just as in previous eras, stability should not mean rigidity. Regular strategy reviews provide an opportunity for self-reflection. We published the result of our last strategy review in 2021, which mainly took stock of the low inflation era, and we expect to conduct and complete our 25 assessment of our strategy review in the second part of 25, which is also when we reach the 2%, by the way. We believe that important elements of the previous review will remain valid, and in particular, we will maintain the symmetric, medium-term oriented 2% inflation target. But there are 2 key areas in which we need to develop our framework to be more robust in times of profound changes. First, we need to reduce as much as possible the uncertainty that structural shifts create. And we can do so by deepening our knowledge and analysis of the ongoing transformations and how they may affect the shocks we face and the transmission of our policy. In that vein, I have strongly encouraged my colleagues and certainly members of staff at the ECB to be determined to enlarge the horizon, to listen to other fields of sciences, to appreciate what transformations are taking place, because you have to understand it before you can actually measure what impact it will have. Second, as uncertainty will nonetheless remain high, we need to manage that uncertainty better. And in particular, we should reflect on how our policy framework incorporates risk assessments. Our current 3-pronged policy framework provides a useful set of cross-checks, and the strategy review provides an opportunity now to consider how to balance the information from baseline forecasts with real-time information, how to make best use of alternative scenarios, and the importance of medium-term orientation when faced with different types of shocks. The 2 main strands of our 25 review will correspond exactly to those goals. First, we will assess the cyclical and structural factors shaping the economic environment in the post-pandemic world. Second, we will review the lessons learned from the low and high inflation periods and our experience with the evolving role of instruments in the policy toolkit. So, history shows that structural shifts matter for monetary policy, even if their effects take time to appear. They affect how monetary policy transmits through the economy, and in the past, they sometimes affected the fundamental goals that monetary policy pursued. Today, the goals of monetary policy do not change, because a focus on price stability has been crucial in times of profound changes. But that does not imply that we're going to conduct monetary policy exactly in the same fashion. And at this juncture, which is the end of my remarks to you this morning, I'd like to quote somebody who in 1933, it's not Alan Greenspan.
Could have been.
Montagu Norman, the governor of the Bank of England, told his chief economist, I quote, "You are not here to tell us what to do, but you're here to explain to us why we have done it." I can guarantee you, and I can promise you, that this is not going to be our approach, and that we will use our best analysis. We will be open to criticism. We will self-examine the pertinence and the appropriateness of what we do, so that with that analysis, that experience, and that knowledge, when the change comes about, then we stand ready. With that, I thank you very, very much.
Thank you, Christine. Thank you. That was wonderful. Thank you. It is wonderful. And
It's not over.
and it is.
I promised a few questions and answers.
And I can say that it is remarkable that we can take the time with you and go through a whole century and recognize that many of the things we are wrestling with have happened before, but the circumstances and the speed with which they're happening are changing. I cannot resist to ask you to start with a what-if question.
Okay.
What if there was an European Central Bank in 1920 and Christine Lagarde was there as a president? When you look back, and it's really incredible, the tour of history you gave us, do you see anything that in these days could have been done differently? Only if there was to be institutional setup for monetary policy of the kind we enjoy today?
That's a really tough question. It's a tough question because you cannot rewrite the past, and you cannot sort of reinvent and assume that the gold standard would no longer be around, and that we would at the time focus on the domestic imperative. But it's true that if price stability had been the real focus of energy and analysis and work, we would probably, the course of history would probably have been different, because the economic facts that led us to 1936 were extremely relevant.
Right.
It was, as it is today, very largely about politics, but also strongly undermined by economics.
Well, my conclusion from this is I regret in 1920 there was no Christine Lagarde in Europe, but I'm very happy that there is Christine Lagarde in Europe right now. Let's go into the important observations you have made about now and the future. You talked about uncertainty in monetary policy transmission. And I have a two-part question. The first one is, when you had your debates in the Governing Council during this very difficult and uncertain time, did you have any observations about channels of monetary transmission that were more potent, more reliable, others that were less? In other words, in these last years, what did you see as really relevant for monetary policy transmission in a world of uncertainty, that are lessons we can ground into? And secondly, You talked about the importance of our analysis and tools. Here at the fund, one thing we are wrestling with is, at the time of more uncertainty, how do we go about models and scenarios? Can we stay in the comfort of what we have? Do we need to think about more scenarios and ranges rather than a fixed point? How do we deal with that how do you deal with this in ECB? What do you think we should do at the fund?
Well, I think what was totally unexpected is not so much one shock, but it was the compounding effect of one shock after the other, or one shock at the time of another shock. And I don't think that anyone was really prepared for that. So what was helpful in that, with that degree of uncertainty that we were facing, in my view, was certainly number one, the mandate. And in case of doubt, I think having a mandate that is very clear, it might be challenged, it might be other mandates could have been better possibly, but to have number one the mandate, to have number two the goal, and the fact that we were in the process of revisiting our strategy at the time, and that we had decided to move away from the close to but below 2%, and to have that medium-term approach. I think the mandate, the target clearly defined, the fact that we tried to communicate, and I had underestimated the strength and the value of communication by central banks. It's a very special exercise, but it's one that clearly has an impact, not in the general public, not in the day-to-day audience, but with financial observers, market operators, and those that actually transmit monetary policy. That I think has been also, it's a difficult learning exercise, granted, but I think, mandate, clear objective, communication. And I guess being also prepared to, number one, admit when mistakes were made. And there is no question that all of us in charge of monetary policy at the time assumed that the energy shock in particular would be a transitory moment, and that we could just see through it, and that the shock that had taken us up would take us down. Well, as a result of the compounding impact and the multiplicity of those shocks, that just didn't happen. And that shock lasted much longer, left much deeper effects, and sort of trickled down into the economy from direct effect to indirect effect, and from the sort of the food chain entirely was affected by that. But I think to have the ability and the humility to recognize that, okay, we got that wrong, and we need to reassess, and we need to re-examine what analytical tools we have, what models we use, how we are prepared to be receptive to different indicators and instruments. I think that was helpful as well. We were the first one, actually, the first central banks to say, okay, yes, we got that wrong. We appreciate that, and we need to address it, remedy, and provide alternatives.
We, at the fund, we also recognize that at a time of high uncertainty, a bit of humility would not hurt. When you talk about
uncertainty, but at the same uncertainty, humility, yes, but clear determination as to where you're heading, and how unwavering your determination is. That's really important.
Yes, and it was and continues to be a source of confidence. You talked about the change that the digital transformation brings to finance. At ECB, you are also quite seriously committed to have a good answer on the question of, do you need a digital euro? Could you tell us a bit about that, and also how do you see the broader discussion globally on CBDCs, digital money, and especially key currencies like the euro embracing a path to digitalization?
You know, that is certainly a cause that I have brought with me from the IMF to the ECB. So if there is blame to be had at some stage, it might come back to this place.
To us, to haunt us.
Yeah. But, you know, it became very clear to me at the time, and when I moved over to Frankfurt, it was no less convincing, that everything was becoming digital. And you think to yourself, well, if everything becomes digital, why would it be that currency, that money, does not become digital? And then you ask yourself, okay, what is money? Number one, it's a public good. Number two, there are two categories. You have central bank money, you have commercial bank money. Aren't we at risk if only the commercial bank operators actually move into the digital world, move into the instant payment, and use technologies, be it DLT or otherwise? Aren't we at risk, we, issuers of central bank money, of being undermined, undercut by the commercial bank money? That's point number one. Point number two, and some of my former colleagues will remember, it was also a time when other national central banks, PBOC was one of them, but not the only one, were charging on and were preparing launch of digital currencies that could have cross-border implications. So then you start asking yourself, okay, there is sovereignty associated with money. And aren't we at risk not only of losing the central bank money that I just discussed, but also of just losing your grip on sovereignty money? And if you combine that with the fact that in 13 out of 20 member states in the euro area, the only cross-border payments, and not cross-border, I'll come to that in a second, but payment instruments were on the backbone of international payment systems that had nothing to do with Europe. You think to yourself, this is fine, but just in case something unpleasant develops, and those backbone of payment systems were to not be so friendly, aren't we better off also having developed something that can be effective within the entire system? Third point, and I come to the cross-border aspect. The IMF certainly was one of those in the early days who said yes, but all of that needs to be interoperational. Because if we just go alone and along with setting up those digital currencies, organizing nicely protected, self-sustained payment system with central bank digital money, aren't we at risk of actually dividing even further what we complain is becoming a more fragmented world? So that cross-border operationability is something that is also absolutely necessary. So that's what we're trying to do. It's not an easy, it's not a journey in the park. It's difficult. It takes time, technologically wise, from a governance point of view as well. And we are in that journey, but we will pursue it for the reason that I've just mentioned.
That is something that we would love to continue to discuss.
By the way, one thing that I found that came as a big surprise to me is two things as we went through that project. One is the attachment of many Europeans, not in all countries, but the attachment in some countries to banknotes. You'd be surprised. I was shocked when I moved to Frankfurt to see how much was paid in banknotes. You'd better have a big wallet there because a lot is paid in banknotes. And the citizens are attached to banknotes. You go to Sweden or you go to the Netherlands, you can hardly pay with a banknote. They send you off and say, bring you your phone. Don't you have another way to pay? So that's the first surprise, big heterogeneity in Europe. Number two, the major concern that people had, because we're constantly testing and checking with potential users and all the rest of it. The main concern that people have is privacy. Big Brother is going to see where I spend my money. So then you try to explain, well, you know what? There are few big brothers when you use your bank account or when you use other devices who actually know where you're spending your money, know what you're interested in, and will send you instantly all those ads and nice proposals. But the concern about the state, because the assumption is that the central bank is going to communicate all information collected to the state. The idea that the state could be privy to how you spend your money is something that is very, very critical for citizens, and not just in 1 or 2 countries, everywhere.
Well, that is really a big cultural issue, I agree. You talked about artificial intelligence, and inevitably it is going to transform dramatically how we work. How much is this a subject of discussion now in ECB from a financial risk perspective, but also from the perspective of how you institutionally adapt to this world of AI?
I'll start from the second part of your question. Just to give you an example, there are 2 things that I will mention. One is critically important to train, to de-dramatize artificial intelligence. Because most people actually, I'm sure that all of you, whether you know it or not, you're actually using artificial intelligence. Whether it's large language models, whether it's on structured or unstructured data, you use artificial intelligence. Maybe not to the extent that some do, but I bet you all do. So what we have started is a process of initiation, training, making sure that everybody appreciates and feels comfortable and not threatened by artificial intelligence. That's number 1. Number 2, I'll give you 2 examples because I find them really fascinating. Because you do macro models and all that, of course, you know how much artificial intelligence can mean. But there are 2 areas where a central bank like ours is actually using artificial intelligence. One is we are producing 1 million documents per year that are translated in 24 languages. Don't ask me why 24, because there are 20 member states. You know, Ireland has a special language that we translate into, and on and on. Well, a big chunk of that work now is handled by artificial intelligence. So 80% of the translation work that is produced almost instantly. Does that eliminate the translators? No, because they still go back to the documents and check and improve and make sure that it is to perfection. Second, as you know, central bank governors, when they meet, when they get together to decide monetary policy stance, their discussions are minuted. Well, guess what? The minutes are no longer taken by actual people. They are produced, at least the first set of minutes, are produced by machine. Now, of course, then experts come in and apply their judgment, and they have been themselves through the meetings and they know how it went, and it does not replace central bankers. The judgment, the discretionary element, all that stays, but it transforms the way in which business is being conducted. Those are just 2 examples. But of course, in macroeconomic modelization, in the analysis of massive more data than only 4 years ago, artificial intelligence plays a key role.
We can sit here and talk with Christine for hours.
Yeah, why not?
I would love to do that. Actually, the audience would love to do that. But we also have to respect your time and your obligations. And we also, Christine, you and I, we want people to go back and do the job they are supposed to do. So I want to finish by asking you, you have been managing director here. You have seen the world changing. What advice you have for us? Where do you see us going? What should we pay more attention to? What should the fund for the future look like?
Well, you know, it might be a little bit narrow-minded on my part, but the IMF is an extraordinary institution. It came about after the shackles of World War II destroyed large portions of the globe. It has a mandate. It has a mission. And I think that to hang on to the mandate and the mission has expanded, because obviously circumstances have changed. And I remember discussions we were having with David in those days, and Sean Hagan and a few others. Rodau comes to mind as well. Should we change the mandate? Should we propose to the membership to change it? And we concluded that no, it's unnecessary, because there is enough by way of, not vagueness, but all-encompassing goal that can actually be leveraged in order to serve the international community. Where I think the fund is we all international, I mean, those of us who believe in democracy, in trade, in the international rule of law and all that, it's a tough moment. And I think in a moment as critical as this, it's vital that the IMF continues to deliver what it was tasked to do under the changing circumstances that we are facing. Now, that does not take you, you know, it probably doesn't help you much. But I think now is not the time to sort of try to identify new business lines and justify one's existence. You have huge justification of your existence. Being that international forum where so different countries have to participate because they all have a stake in that game is absolutely vital. So please keep at it and make sure that you deliver on that mission for the world. Multilateralism is not a very, very sexy and popular principle, but we are on this single planet together, and we'd better make sure that we live together and we don't destroy each other. You have a role to play in that respect, very much so.
It's a fantastic message. Stand up and be counted in this world. Thank you, Christine, and stand up and big round of applause to Madame Christine Lagarde, back at the IMF. Thank you. That was wonderful, Christine. Christine,